watching Property TV.
Hello and welcome to Property Summits, the show to tune into to find out all about the latest developments in the property world from 6 of the most experienced people in the business. And first off, John Howard, a man who knows a thing or two about property, having bought and sold a staggering 3,500 houses, apartments and developments over more than 4 decades in the industry. We also have Tony Gimple, the man in the know when it comes to tax, accountancy, finance and succession planning. Also joining me is Nicholas Wallwork, an investor and developer who makes the most of his expertise in his role as CEO of the world's largest international property forum. Richard Bush is here too, founder of the crowdfunding platform Landlords, which provides more people with the opportunity to invest in property. With me too is best-selling author and serial entrepreneur Paul Mahoney, founder of Nova Financial Group, providing property investment advice with a particular focus on the buy-to-let sector. And last but not least, a new member of the Property Summits team, Ranjan Bhattacharya, a man who's been investing and developing property for 30 years and uses that experience as the country's leading educator of property entrepreneurs. It's lovely to see you all.
Thank you.
Thank you.
So, crystal ball time. What's happening with the property market, John, in the years to come? This is your area.
Well, of course, as I said at Christmas time, when I get asked this every year, you get asked this by people in the industry.
By your wife.
And people outside the industry, absolutely. And I say, well, 3 things can happen. It can either stay the same, it can either go up or it can go down.
Really?
And in time, I'll let you know. So, but here we go. So we're now into, we now had a few months, so I think we can see where things are going. To get the answer, ask the question. The question is this: are interest rates going up? The answer is
yes.
Slowly.
They're going up.
Slowly.
Are properties staying on the market longer before they're being sold? The answer is yes. Are there more reductions on in the market in terms of property prices coming down for property that is not yet sold? The answer is yes, they are coming down. Is the economy looking strong? Yes, it is at the moment, but you have to consider with inflation, with the cost of living, and all the other problems, you can only see the market surely going one way, and that is getting tougher to sell your property. If it's tougher to sell your property, then the whole thing starts, revolving round and so on. I'm not saying that the property letting market, the people who want to do buy-to-lets, the sort of some of Paul's clients, for instance, they're not going to have a problem because they're borrowing the money over a 25-year period, and over a 25-year period, I'm sure everything will go up nicely.
And rents are going up.
And rents are going up too. And of course, when sales cease, then more people rent, so the rental market gets stronger. But I just see pretty big problems, especially for developers who perhaps are halfway through a development. The build costs have gone up. The builder can't afford to finish the job. What happens? So I think for the investor, nothing really to worry about. If you've got property, it might be stagnant for a year or two. Might go down a little bit, but who really cares? Over time, it will go up. Your rents will go up anyway. But I think for property developers, that's where the problem is. And the one question I ask myself, what do you think is going to happen if all the banks start getting cautious and lending less to developers especially? So loan to value, say 70% at the moment, they start reducing that to 60 or 50%. That will ring alarm bells in many people who are looking to invest in property, I think, and that's what we're cautious of. And of course, I've survived, like Ranjan probably. I'm putting you and so on. We've survived 3 property recessions, I think, haven't we, between us, 3 each, something like that. So that's what you've got to be wary of.
But Joe, you're not saying that a property recession is coming, just that the market's going to get tougher? What is your main point?
I would say the market is going to get tougher. And what we must remember, all this great news coming out from all the big property portals at the moment is 3 months out of date. You know, we're at the sharp end. They're 3 months out of date. Their data is 3 months out of date. So what we can see happening now, they will see happening in 3 months' time.
Well, now we're all ready to throw ourselves off the nearest building. Let's think of the positives for developers. And the big one you touched upon is the economy. We are coming out of COVID. There's still pent-up demand. We had a massive flurry last year of particularly home sales. But I think, you know, the key and our message that we try and put out with Property Summits is if you treat your property investments like a business, you're going to be at the sharp end of making the money. And it's even more reason to stay sharp on the market trends at the moment, isn't it, John? Yeah.
I would say absolutely right. Be cautious.
I think it's important to get the full picture when you're talking about things like this, because you know, John kind of reminded me of mainstream media then with his opening statement.
I felt
that
like
would
I was
have been
reading
the headline, and everyone thinks,
the BBC.
no, steer clear of property.
Yeah,
I want to buy more this year, and I want to get the price down. It's nothing to do with that.
He's just negotiating
ulterior
everyone down.
motives from John.
But then John expanded, and actually I agree with the full picture he gave. That, you know, I think Nationwide did release some stats recently that year-on-year growth was 14%.
Yep.
You know, that can't happen every year. So of course growth over the next year is going to be less than the last year. It might still be positive though. So, you know, it all depends on the time frame you're involved for. And John is more so talking from the perspective of a developer who is looking at a 12 to 24 month project and needs to get out and pay back millions of pounds probably at the end of that project.
Yep.
If there's a tough market at that very point in time, they need to get out. That's a problem. If you're in it for the mid to long term, it's not.
I agree, Paul. And I said that, didn't I? I said, if you're in it for the long term, actually, you know, what does it matter? It goes down a bit, comes up, back up again, and so on. But Richard, from your point of view with finance, I mean, how do bankers see turbulence in the market?
Well, bankers are all very cautious anyway, so they always see the potential negative before
Too
the
late
rest of
normally.
us do. I want to pick up on something Paul mentioned there, because I think it's really important, is that, you know, the nationwide figure was 14% on average. There were some towns and some places that were 25, 30%, and others that were 3 or 4%. And like you always say, Paul, and it's good to be reminded, is that it's not a single market, and every single town and every single development is facing a different market situation. But yeah, typically banks are very cautious, and I do expect them to lower the amount that they'll lend.
I agree with what you said on developers. Developers are always looking to extract the maximum value at the end. And what's happened is the rate of growth is coming off.
Yeah.
And when the rate of growth it comes off, then that's when you see price reductions, because people have put properties on the market as anticipating the same rate of growth. So that is dropping. But we are going through a massive period of inflation. And inflation is historically quite good for property investors, because at the end of the day, it doesn't matter what the headlines say, it's probably double digit in real terms. So that means if you've got 100 grand, the feeling of what you can do with that 100 grand in 1 or 2 years' time is going to feel that it's worth less. And then it doesn't take long before the property price feels worth less, along with that feeling of what 100 grand can buy you. So property catches up. The other interesting thing which the Bank of England have done, they put out a consultation paper. They're changing the way they're going to do mortgage affordability. So in 2008, when the credit crunch hit, they made some rule changes. And one of the things, if a domestic home buyer takes out a fixed rate mortgage, they will stress test it, not based on the fixed rate mortgage rate that they pay for the fixed rate period. They'll stress test it on the reversion rate, the variable rate. But now they're saying they're going to stress test it on the pay rate. Now that is going to mean that if prices go up with a little bit of inflation, yes, there's a cost of living crisis and things are getting more expensive, but lenders will be able to lend a little bit more, because the reason they brought in these rules after the credit crunch was because banks were stuffed. They're much healthier now, and that's why they're relaxing them a little bit. So I think there are a lot of things that will say, yeah, the rate of growth will fall a little bit now, but in the medium term, it's going to be
But Ranjan, what I would say, I hear what you say, and you're absolutely right about the Bank of England. But what I would say, when people start hearing negativity, people talking the market down, and so on.
Who would do that?
Who'd do that? Who would ever do that? And being honest, who would ever be that?
Well, be honest, I'll
as
talk
I
the
am,
market
as
down.
I am, and Tony is, and the rest of us are here, and we can afford to be honest, and that's the difference between, I think, the property summits and some other types of organisations. But what I would say is that the negativity is the key to this, because it's a self-fulfilling prophecy in as much that once a couple say, well, I'm a bit worried about buying now, I'm going to leave it, the whole thing starts to, and the cost of living, if people buy 10 coffees a week, and they say they only buy 1 coffee a week because they can't afford it anymore, then it's a knock-on effect all the way down the chain. The person loses the job because they're not making enough coffee, and so on, so on, so on. And that's the issue. With inflation, it's very interesting. During a recession, there's really never any inflation. And we're in a very odd position now, and one that perhaps we haven't seen before, in as much that the economy's doing well, but we've got huge inflation. I think inflation's 20% when you add a year, when you actually take into account what people buy every week, which is energy, petrol, diesel, and all the rest of it, food. Is the property market going to keep up with the inflation, which is what it's done in the past, or is it not going to this time? And that's, to me, a question I don't know the answer to, and I'd love to hear your comments on that.
Well, does it always catch up? I mean, it might not keep up, but it will catch up. It might not catch up this year, but it will like Ranjan was saying, it will catch up.
Short term, it's not catching up because of all the inflation of materials, with the issues with the war, with Brexit and various other things. That's gone skyrocketing 400%. Obviously, property's not going to go up 400%.
But there's two sides to that argument as well, right? We already have a massive undersupply.
Yes,
and COVID has caused that undersupply to get worse.
Yep.
This building cost increase, which is crazy, is going to cause more of an undersupply. It's hard to find projects that actually work.
Absolutely.
There's plenty that we've passed on because we just can't get decent building prices.
Yep.
That means that there's less houses being built again, and that means that in a year from now, the supply will have been less than if we didn't have this inflation. So, there's always two sides to it, isn't there?
You are watching Property TV. You are watching Property TV.
There's a critical balance, between keeping inflation under control, building enough homes, getting enough tax take to, for the state protection racket to do its job, dealing with pandemics and the occasional war, and the blunt instrument of interest rates being put up by the Bank of England, which actually fuels inflation, makes more people homeless. All right, yes, it does erode the value of debt over time, but it's not good. Look, we've got an opportunity, I think, yes, and prices may well fall in the short term, both for commercial, residential, but people still need a roof over their heads. So you'll be out as developers, as buy-to-let landlords, social houses, whatever. Probably you will be able to buy reasonably good value over the next year to 18 months. But beyond that, particularly by the time we get to the next election, I think you'll find that the economy will boom, tax take will fall, but at lower individual and corporation tax levels. And one of the things is, I think the government has realised it made a huge mistake when it came to Section 24. Forcing everybody, down that, on the buy-to-let side, to incorporate or to cap relief.
I disagree, Tony, with you. I think that's excellent, the fact the government have done that, because there's so many landlords who weren't paying the proper tax and weren't paying capital gains when they sold. And if it's all under one umbrella as a limited company, then they have to provide annual accounts. I've always had a limited company from the age of 18 years old. And I just think it's the professional way to do it. And I know people are moaning about it, but ultimately, the people that are moaning, some of them are moaning because they've got to declare the correct amount of tax.
But you're talking about doing it as a business. If you're the GP and you just want to buy a couple of houses for your pension, they're not doing anything professionally, unprofessionally. They're paying their taxes. They're having them professionally managed through agents. There's no reason to push them down the incorporation route. Just because a few people aren't evading tax, they should be pursued. Just because people smash up bars, you don't
Ranjan,
shut down all bars.
They spoil it for everyone else, of course. But ultimately, that's why the government have done it, because they want to make it more professional. They want to know who's who and who's paying tax and who isn't.
No, but my point is, as I said, the professional, the GP who's got a couple of houses as a pension, they're professionally managed through an agent, they're paying tax. There's nothing unprofessional about what they're doing.
I don't disagree. I don't disagree with that.
Push them down that avenue.
But that's happened because of the ones that've spoilt it for everyone else, the people who aren't paying the proper tax.
I think there's a deeper political reason behind that. It wasn't so much that people were avoiding or evading, which is
they have, Tony.
Well, they
big
have.
time.
Yeah. But it was also the fact that the Treasury was pretty bare after the last Red government, and somehow you had to raise money, and landlords, the private rental sector in particular, was a really easy target. It won votes.
But interesting, that hasn't affected the value of property, has it?
No, it hasn't.
It's going
Not in the
forward, talking
slightest.
about property prices and so on.
When we talk about property pricing, microclimates is a good example. We don't own the UK property market. We can't invest in the UK property market. So it's almost a bit silly to talk about it, isn't it? Because this property we're sitting in right now has moved at a much different pace to a property up in Edinburgh. Very, very different. They're not even on the same scale. So, much better off talking about the individual properties that you're buying and the prospects of them, as opposed to just the market as a whole. If we speak about, if Nationwide's right and property price growth has been 14% over the past year, I certainly haven't noticed. Have you?
Well, you haven't noticed it go up?
I haven't necessarily noticed. I've been buying properties over the past year. I own properties. I haven't noticed they've gone up by 14%.
I know
as
what
a funder,
Paul's
we've
saying.
noticed a lot of developers selling way above what the RICS valuation was when they started.
But my
way
point,
above, 25%.
my point is, of course, that's what's got them out of jail last year.
Yeah.
The fact that there has been some property inflation.
Yeah.
But it won't get them out of jail next year.
No.
And that's the difference.
I think the point Paul's saying is that when people talk about the average in the property market, it's a bit like investing in stocks and looking at the FTSE index. The people watching this are property investors, property entrepreneurs, and you'd be looking to outpace the FTSE. If you're a stock investor, you'd be looking to outpace the property market when you're dealing with property. And I think that's the point you're making. You're looking at individual deals in individual neighbourhoods and what you can do to add value to those individual propositions. And that shields you from these. I mean, really, what's happening to the property market is a little bit of nice banter discussion, but it doesn't really stop us from doing deals. We've all done deals.
Ranjan, but I remind you that the property
periods.
market in 2008-9 went down 30%.
But you did deals then.
Sorry?
You did deals then.
Well,
throughout those years.
To be honest with you, I actually saw that happening and did very little for 2 years, and then we're coming out of the recession. I've always made more money coming out of a recession than any other time, property recession, any other time. But yes, you can do deals, but remember, it's a falling knife. You've got to be very careful in that situation. Very, very careful in that situation.
I was quite interested in what you were talking about with building materials. You said that there have been deals you wanted to do, you've got the quotes in and it's just too much. I think people might be interested in getting a sense of how you think that's going. Are we going to see building costs coming down gradually, or are they just going up and up and up?
Everyone I speak to seems to say that once these things go up, they don't tend to come back down again. They might come down a bit, though. John probably knows better than me.
I think maybe they might come down a little bit, but on the whole, once people have had the benefit of an increase of profit, they don't like then to reduce. These suppliers don't like reducing it, do they? And it's a worldwide problem, isn't it?
Yeah, and a lot of the price increases were caused by lack of supply due to unusual things like COVID.
Basically, no stockpiles.
COVID were coming out of that, so you'd have thought if logic applied that those prices would come down as we had more 4x2 or whatever it was we need.
Yeah, but they're never going to come right back down to what they were. And likewise with people costs, they've gone up because of a lack of workmen, and that will come down again.
And inflation. Yeah. So all in all, I think that's quite tough.
And it makes it tricky for someone at the top end when you're doing big developments, but also someone who might be thinking, right, I do want to get a buy-to-let or two for my pension, because the margins become tough then, don't they?
Yeah, they do. But what I would say is that if you're looking at a property to keep, then you can sustain a bit of extra cost.
You look at the long term, so it's back to that again.
Yeah, exactly. Yeah.
Yeah, these short-term changes, when we say short-term, we're talking, 12 to sort of 36 months type changes, they don't really affect buy-to-let investors as much. So long
When you're
as you have
talking
a tenant,
pension, that's long-term by the nature of it, isn't it?
exactly. You know, so long as you have a tenant in those properties, you won't notice these short-term changes unless you have to sell due to some catastrophic event. So it's more about the mid to long term in that case.
But for developers, they can be devastating, can't they? Because if the timing is wrong, then the combination of COVID and Brexit and cost inflation and so on can have a devastating effect unless you've got an alternative.
You're making me sound like I want to retire.
Well, I thought you had.
Probably about time, isn't it, John?
I think
Property prices are falling, so we can buy your assets from you.
Thanks very much. Yeah, thanks, guys. Yeah.
You're absolutely right, Rich. I think it's key about having the right people around you, isn't it, and treating it professionally, and that's what we do at Property Summit.
And taking proper advice. And not
taking
burying your
proper
head
advice,
in the sand.
spending money on the right advice,
Yeah.
and being careful about the things you buy and the numbers involved. Getting a proper QS to price up a site, for example. Getting that professional team when you get on the construction phase, designing the site properly and cost effectively, looking at what's out there in the market for grants. There's various solar benefits out there now. I'm actually trying to get some on my house at home, because my energy bill doubled last couple of months. And so it's hyperinflation in the short term. And what's frustrating actually, as we've touched on a couple of times, is in terms of getting deals at the moment from development point of view, or a doer-upper, or a Class MA conversion in the high street, the vendor's expectations are still super high from 6 months ago, and the prices are too high. And so that sort of delay in the property market hasn't quite hit yet. And I think this year it's going to hit.
We'll get the correction.
And the deals
There'll
will
be a
be
correction.
coming on board now, hopefully.
It's starting to happen.
Starting to happen,
We've started
yeah.
seeing that as well. Yeah.
So overall, to round it off, give me a sense of how optimistic or not you feel about the next, let's say, year, and then maybe 5 years. Crystal ball.
Well, I'm very excited about the market coming down a bit, because it allows a number of people to do more in the marketplace and to push on with their property journey in many ways. So, when there's a bit of blood on the street, as they say, then there's lots of opportunities. And I think, sadly, mainly for developers, especially developers who aren't very experienced and haven't been through this situation before, I think it could be very tough in the next 24 months.
John's optimistically pessimistic.
But,
I think that even in a bad market, you can still do well with the right opportunity.
Yeah.
So obviously you probably need to pick more carefully, but you can still do really well. Even if the market tanks tomorrow, you can still do well over that same time frame.
And as long as the V in VC is venture and not vulture, it will eventually encourage more people onto the housing market as developers, as landlords, as homeowners, and that's where you get real levelling up. So yeah, if you have to sell, sell. If you don't feel confident, sell. But other than that, the market is the market. Classic case of supply and demand. And if prices do really fall, particularly for developers, I'm sure we'll be doing a VC for John here just to boost his pension fund.
that's kind of you.
My pleasure, sir.
Thank you.
Well,
Remember
gentlemen,
who our friends are.
thank you very much for your vision. The future, we'll see whether it all pans out as you think it might. And thank you very much for joining us. We'll be back with more next time.